Hello everybody, it's Yashar here, back again with another video, and in this video I will cover the Aritzia earnings report which released last Thursday after the closing bell. Aritzia had a terrible performance this year, and even after a relative jump after this earnings report, it is still down almost 50% this year alone. It is one of the largest positions in our stocks portfolio and by far the worst performing stock in my portfolio. I personally continued to buy the stock in the past couple of months despite their past weak earnings report, as I thought while the business fundamentals seemed to get worse, I felt like the business issues are more related to macroeconomic conditions and reduced consumer spendings than Aritzia brand itself. To be clear, most of the other retailers like Nike, Steel Ladder, Ulta Beauty, Sally Beauty, Victoria's Secret, they all got hammered this year too due to weak retail activity. So weak earnings is not only a problem for Aritzia, but it's a problem with consumer discretionary sector during a high interest rate and high inflation environment. So I went into this earnings report with very low expectations as I knew that the numbers should not look good. I should say this earnings report was actually terrible in terms of the numbers. But because the market was already priced in the worst case scenario, the stock actually rallied briefly on top of this earnings report. Aritzia stock was up almost 12% at some point after the earnings on Friday, but ended the day with almost a 6% positive move to the upside. Despite this price action, pretty much all the numbers in this report were awful. Let's go over the most important numbers in Aritzia earnings report. Net revenue increased only 1.6%, which is of course mostly due to opening new stores by Aritzia. United States net revenue increased 6%, which means their business in US is going much better than their business in Canada. Their e-commerce net revenue decreased 1%, which is basically flat. Revenue growth is the only number that I can give Aritzia a pass in this environment. But on the negative side, comparable sales, which means the same store sales, declined by 4.3%, which is really bad. Gross profit margin decreased 690 basis points to 35% from 41.9% last year, which is again awful. Adjusted EBITDA decreased at 74.4%, net loss per diluted share of 5 cents per share, compared to 40 cents income per share last year. They basically went from a profitable business last year to a business that barely makes any money this year. And finally, adjusted net income per diluted share of 3 cents per share compared to 44 cents per share in the last year. These numbers are terrible, and based on only these numbers, you expect the stock to crash by more than 20%. But as the market already priced in even worst case numbers, the stock actually jumped after this earnings report. For me personally, growth doesn't concern me, as I understand the difficult macroeconomic condition for a retail business. And I also understand that Aritzia heavily invested in developing new warehouses and expanding their retail footprint. For example, their capital cash expenditures were 45.7 million this quarter, compared to only 22.8 million last year. They mentioned that this increase is primarily due to capital investments in new boutiques, expanded or repositioned boutiques, distribution centers, support office expansion, and technology infrastructure. I don't have any issues with these type of investments, which has temporary effect on the earnings of the business. My main issue with Aritzia lays with increasing inventory and sales and administrative costs, and therefore lower profit margins. Sales, general, and administrative costs of Aritzia increased by a whopping 32% this year, which is a lot. They mentioned the increase in SG&A expenses was primarily due to investment in retail wages and support office labor made in the back of the fiscal 2023, as well as distribution center project costs. I don't like to see a huge jump like 32% increase in sales and administrative costs here. Also, they have an increase in their already troubling inventory level. The inventory at the end of Q2 2024 was 500 million, an increase of 10.1% compared to 455 million at the end of Q2 2023. On the bright side, while the management said the revenue and margin will continue to be flat or slightly down, the inventory will be improved on the sequential quarters, So there is a hope right there. Now the question is what I'm trying to do with my shares in Aritzia. I have an overall conservative portfolio, and of course Aritzia was the only high risk, high reward stock in my portfolio. With that being said, I still don't think my analysis on the company was wrong, and I'm not going to sell any shares of Aritzia here. I will actually continue to buy more shares of Aritzia, maybe not aggressively as I already have a large stake in the company, but I will continue to buy few shares here and there. I still believe Aritzia can continue its growth in the future, and the investment in new warehouses and e-commerce business will result in margin expansion over the long term. Hopefully this short-term pain will result in long-term success for the company and investors. What I want to see in the next earnings report of Aritzia is not share buybacks or growth numbers. I want to see that the management team will try to control the administrative costs, reduce the inventory, and stabilize the margins in the next couple of quarters. If they can fix the margin problem and inventory problem, I believe Aritzia share price will also rise again. So for now, I will keep my shares, buy few more shares during these dips, and monitor the next earnings report of the company. There you are, guys. I hope you enjoyed this short video. I will be back with an update on my stocks portfolio very soon. But until that time, I see you guys in the next video. Farewell.